There's a concept in property and casualty called the attractive nuisance. Now, if you've ever sold this type of insurance, you know what it is. The classic example is the kid and the pool. You know, in order to keep a kid safe, you got to have a fence, because if a child gets hurt in your pool because there's no fence around it, you can actually be held liable for that problem or that injury or that even death that occurs as a result of it. Well, there's the same type of thing in the concept of finance and investing. We have attractive nuisances. Let's say you've had an investment that recently had a high return, or maybe it's a popular asset category, or possibly we have something that's cheap to manage. That's a very attractive trifecta right there of things that would attract an investor to these things. If you look at large U.S. stocks from 2009 till now, it's had quite a run over that period of time. Now, if we look at the 1970s, the attractive nuisance would have been international stocks. They did very, very well compared to U.S. stocks, and we would have been very attracted to them at that point in time. Yet, during the period of the early 80s, U.S. outperformed international. Then the late 80s, international outperformed U.S. And then you got the 1990s, U.S. outperformed international. But in the late 80s, I actually had people mentoring me, telling me, hey, don't bother putting any of your clients' money in U.S. International is the way to go. Would have been a really bad decision. In the late 90s, of course, U.S. had done really, really well. You had the tech bubble, and people really got excited about it and jumped in droves and ended up losing a lot of money. Then in the 2000s, international outperformed U.S. And it's back to U.S. outperforming international recently, as I said earlier. Over the longer run, what we see here is a combination of U.S. international is the red line, and you see that it has less volatility than the parts. That's why we diversify between both of them, because it reduces the bumps in the ride, so to speak, in the investing process. Now, the other thing we got to think about is this. If we look at any given year, we see that, sometimes U.S. large stocks are the top returning asset category. From 1970 till now, about 14% of the time, large U.S. stocks were the top performing category. That's why we own them, because sometimes they are. But a lot of times other asset categories do better or have the top returning year. Now, the other thing to think about is the growth of money. If you look at the investment rate of return of large U.S. stocks, it's way over here to the left. It's actually one of the lower performing asset categories. So that's why we don't put everything there. Now, another thing to keep in mind right now, after you've had a good run in an area of the market, remember that that area of the market has had a good run. Trees don't grow to heaven. They won't go up forever. Large U.S. stocks right now are selling for a high price compared to book value, compared to other asset categories. So it's another reason not to concentrate too much money there. So the attractive nuisance with the pool, it's a fence to keep the kids safe. Well, with investing, it's coaching to help keep you safe from doing something that you may end up regretting later.